In every APM exam, there is at least one question asking you to identify CSFs and suggest KPIs. It sounds simple, but most students lose marks by not linking them properly. In this video, we will cover everything from definitions to financial and non-financial themes to industry KPIs to exactly how to write a full exam answer. Let us start with the definitions. A critical success factor or CSF is the condition that must go right for an organization to achieve its objectives. Think of it as the answer to the question, what must go right? CSFs are broad, strategic, and qualitative, not a number. An organization typically has 3 to 6 of them. A key performance indicator or KPI is the quantifiable measure used to monitor whether a CSF is being achieved. It answers the question, how do we measure it? A KPI is specific, measurable, has a target, and tells management what to act on. The relationship is simple. The CSF drives the KPI. The KPI measures whether the CSF is being achieved. Here is the golden rule. Every KPI must be linked to a CSF. In your exam answer, always state, this KPI measures whether the CSF of X is being achieved. The model answer template is a suitable KPI is the name. This measures what? It is relevant because the CSF is X and this KPI monitors whether that condition is being achieved. If this KPI falls below the target, management should take action. A strong KPI is specific, measurable, linked to a CSF, and actionable when off track. Now let us talk exam technique. There are 3 steps. Step 1. Read the scenario. Identify the industry. Hospital, airline, retailer. Spot the theme. Is it about cost, revenue, quality, or people? Find the CSF. What must go right? Ask yourself what management is worried about. Step 2. Choose your KPIs. Pick 2 to 3 KPIs per CSF mentioned. Always mix financial and non-financial. Make them specific to the industry. Include a target or benchmark if the scenario gives you data. Step 3. Explain the link. Name the KPI clearly. State what it measures. Link it explicitly to the CSF. Say what happens if it falls off track. Scenario 1. CoastalCare NHS Trust operates 3 regional hospitals. Its mission is outstanding, equitable care for every patient. Its target: cut waiting times by 30% and bring cost per patient day below the national benchmark of £480. The scenario tells us regulators have flagged a breach of the 4-hour A&E target. Staff costs are 12% above budget. Bed occupancy is running at 94%, well above the safe level of 85%. The CSF is deliver safe, timely and cost-efficient patient care. Now, why these KPIs? Patient waiting time, because the scenario explicitly flags the 4-hour A&E breach. Bed occupancy rate, because the scenario gives us a specific number, 94%, and tells us the safe threshold, cost per patient day, because staff costs are 12% over budget and the board has set a benchmark of £480. Readmission rate, because high occupancy can pressure early discharge, leading to patients returning. Model answer. A suitable KPI is average A&E waiting time. This measures the time in hours from arrival to treatment. It is relevant because the CSF is timely patient care and this KPI directly monitors whether that condition is being achieved. If waiting time consistently exceeds 4 hours, management should review staffing levels, triage processes, and bed availability. Scenario 2. Sunrise Hotels is a 4-star luxury group with 12 properties across Europe. Its vision is to be the most trusted name in boutique luxury travel. Its objective: grow RevPar by 15% over 2 years while maintaining a guest NPS above 70. 2 new competitors have opened in its key city locations. Direct booking rates have dropped from 60% to 44%. Repeat guest rate has fallen from 38% to 29% in 12 months. 2 CSFs emerge: maximize room revenue and retain guest loyalty. Why these KPIs? RevPar. Because the board's explicit objective is 15% RevPR growth. Direct booking rate, because the scenario tells us it fell from 60 to 44%. Recovering this directly reduces OTA commission costs. Repeat guest rate, because the scenario explicitly flags the fall from 38 to 29%. This is the loyalty signal the board is most worried about. Model answer: a suitable KPI is RevPR. This measures revenue per available room per night, combining occupancy and pricing. It is relevant because the CSF is to maximize room revenue. If RevPAR falls below the £180 target, management should review pricing strategy, direct booking incentives, and channel mix. Scenario 3. GreenMake Limited manufactures sustainable packaging for FMCG clients. Its mission is to lead the transition to zero-waste packaging. Its board has committed to net zero carbon by 2030 and a delivery rate above 98%. A major client representing 20% of revenue has issued an ultimatum: meet a carbon intensity target of 2 kilograms CO2 per unit by next year or lose the contract. OEE has slipped from 82 to 76% due to aging machinery. The defect rate has risen to 3.2%, above the 2% quality threshold. 2 CSFs: efficient on-time production and reducing environmental impact. Why these KPIs? OEE. Because the scenario tells us it slipped from 82 to 76% and cites aging machinery as the cause. Defect rate. Because the scenario explicitly gives us the current level, 3.2%, and the threshold, 2%. Carbon emissions per unit, because the client has issued a specific ultimatum with a hard deadline and a contract at risk. Supply chain sustainability score, because meeting the carbon target requires verified upstream sourcing changes, not just in-house production changes. Model answer: a suitable KPI is carbon emissions per unit of output. This measures kilograms of CO2 equivalent per unit of packaging manufactured. It is relevant because the CSF is to reduce environmental impact, and it directly monitors progress toward the client's 2 kilogram target. If emissions per unit remain above target, management should review energy sourcing, production processes, and raw material suppliers. Finally, 4 common mistakes to avoid. Mistake 1. Listing KPIs with no link to the CSF or scenario. The examiner wants to see the connection. Always state it explicitly. Mistake 2. All KPIs financial. You must always include a mix of financial and non-financial KPIs. Mistake 3. Vague CSFs used as KPIs. Saying improve customer satisfaction is a CSF, not a KPI. Make it measurable. Customer satisfaction score percentage measured by monthly survey. Mistake 4. Generic KPIs that could apply to any business. If the scenario is a hospital, say patient waiting time, not just efficiency ratio. Industry-specific KPIs score more marks. That covers the full APM KPI and CSF framework. To download the complete 7-page cheat sheet covering every theme and every industry, visit revpro.club. The link is in the description. Follow RevPro ACCA for more APM, SBR AFM, and SBL revision.